This video will allow you to improve your analytical skills using the Wyckoff method and more precisely understanding the law of effort versus result, or the correlation between volume and price action. An analysis based on the law of effort versus result is based on the relationship between the price action and the volume, and allows us to interpret whether the interest in a particular action is true or false. In financial markets, the effort is represented by the volume and the result is represented by price. This means that in theory the price action should be reflected by the volume action. Without effort there cannot be any result. Our job as traders is to evaluate the dominance of buyers or sellers through the convergence or divergence of price and volume. Perhaps even more important than the price, the volume is part of the cornerstone of the Wyckoff method. The volume identifies the amount of stock, crypto, or any tradable unit that has changed hands. When traders are interested in an asset, this will be reflected in the traded volume. A key concept to remember is that the participation of large traders can be observed through a notable increase in volume. If the effort is in harmony with the result, so the volume is increasing and the price is also increasing, we can say that the market shows a sign of strength, and it suggests continuation. If the effort is in divergence with the result, we can say that the market shows a sign of weakness, and that suggests a reversal. You should also be aware that if the two are in harmony, a major effort will cause a movement with a longer duration, and a minor effort a shorter duration. Analyzing candle by candle. Analyzing price action and volume based on individual candlesticks is one of the simplest effort versus result evaluations. Candlesticks are the definitive representation of the battle between buyer and seller, and the final result transmits a signal to us. Our job as traders is to interpret the price action and volume, in this case, by isolating each candle. We will always be looking for an alignment between the traded price and volume. For a signal of harmony, we would expect wide ranges at high volumes and narrow ranges at low volumes. The opposite would indicate a divergence, the subsequent shift. We want to evaluate if the volume generates a movement in the direction of the original candlestick, or if, by contrast, after observing that increase in volume, the price moves in the opposite direction. Usually, at the beginning of each impulse, there is a relatively high volume that supports it, whereas this volume is not seen at the beginning of a correction. We would expect to see high volume at the origin of an impulse. This would also indicate institutional presence that can be supporting that said movement, and usually leading to continuation. On the other hand, a movement with low volume would suggest the institutional participation is not there, and due to the divergence we can observe the price would probably revert, as institutions have no interest in pushing the price in that direction. So, as a general rule, impulses will be accompanied by an increase in volume as the price moves in the direction of least resistance, and movements that have a corrective nature will be accompanied by less volume. We have harmony when we have impulse with increasing volume, and we have a divergence when an impulse is accompanied with a smaller volume compared to what we have seen before. Analyzing volume by waves. A key fact to keep in mind when analyzing volume waves is that not all volume traded in a bullish wave will be purchases, and not all volume traded in a bearish wave will be sales. There is harmony if in an upward movement the bullish price impulses are accompanied by bullish waves with a greater volume than the bearish corrections. Key levels. If the price approaches a level of resistance, or a support with volume, and performs a breakout, we can say that there is harmony between the effort and the result. If, on the contrary, the price approaches a level with volume and performs a false breakout, we can say that we are dealing with a divergence, as all the trading volume has participated in the opposite direction of the breakout. The key here is to see if the price can hold the other side of the level or not. As long as the price action holds the level and the volume remains constant, we can consider that the breakout is real. This type of volume analysis can be applied to any type of level, be it horizontal or sloped, trend lines, channels, inverted lines, converging or diverging lines. It can also be applied to dynamic levels like moving averages, VWAP, bands, and more. High volume at the end of a move. Usually, large volumes accompany the termination of a prolonged trend movement, especially if in the latter part they are accompanied by smaller and smaller price advancements. Therefore, extremely high volume after a prolonged uptrend or downtrend indicates that the end of the movement is imminent, and that the distribution phase may be beginning. Low volume at the end of a move. Another way in which the price reversal may occur is with a general lack of interest. Small volumes at the bottom of the market after a significant decline or a bearish correction generally indicate the lack of selling pressure, and therefore a lack of interest in selling further. If there is an appearance on the buyer side, the price can follow an upturn. Similarly, small volumes at the top of a move after a significant rise can show buyer side lack of interest, and the appearance of sellers can cause the price to downturn. That's it for this video. Now you know how to interpret volume action and correlate it to the price action from an individual candle to larger market structures. If you liked this video, please like and subscribe to our channel, and see you in the next one.